once again. We welcome you to this enlightening webinar session with Sovereign Finance Company Limited. We thank you for being here. We thank you for, answering or yielding to our call when we did. We thank you for your time. As we begin the session, we enjoin you to have your expectations in order to channel the path through which you're going to apply the strategies that you learned from this session. We implore you to please, as much as possible, pay rapt attention. If you have any questions in the course of the webinar, please drop them in the chat room as they'll be attended to during the question and answer segment. Once more, we welcome you. Today, we'll be joined by two speakers, Dr. Olatunji Eson, the Chief Operating Officer of SFL Asset Management, and Mr. Anthony Kumba. He's currently the Divisional Head of Credit and Commercial for Sovereign Finance Company Limited. We'll start the session in a bit. Just give me a moment. Okay. Once again, thank you very much for joining us. Sorry, I just needed to confirm that we have our speakers here, which we do. Okay, so as earlier said, this session will be facilitated by Dr. Olatunji Eson, who's currently the Chief Executive Officer of SFL Asset Management. He has vast experience within the financial services sector in and around treasury operations, investment portfolios across companies like ARM Investment Managers, Maristem, prior to being the CEO of SFL Asset Management. Please join me to welcome Dr. Olatunji Eson as he begins the session for us. Hi, Doc.
All right, thank you, Precious. Yeah, good morning, everyone, and welcome to today's session. It's no secret that we're facing a challenging economic environment. Interest rates are rising, inflation is biting, and businesses are feeling present the best opportunities. So today, we'll be exploring on how to not only survive, but thrive by borrowing smartly, even when interest rate seems to be very high. So how do we get it right? First, it's about properly assessing your financial needs. What do you truly need the loan for? Is it to buy essential assets? Is it to expand your operations? Or are you managing any cash flow? So you need to be clear on why you need to borrow. I'll take, for example, we have an agri-tech company in the company of Farm Crowdy. They recently did an expansion plan to which they assessed some loans to be able to grow and actually grow their platform. This they were able to do because the future demand in agriculture will justify the borrowing that they are doing. After this, we also need to evaluate our loan options. Look at the market and compare rates, terms of the loan, and repayment conditions. Not all loans are created equal, and understanding the differences between them can help you make the best decision. You don't just take the first option that is available. Take your time to compare the rates and negotiate terms that fit your long-term goals. Finally, we'll also be looking at how to implement smart borrowing strategies. Borrow with the future in mind. This means planning not just for today, but for the long term. So you can continue to grow even when borrowing costs are high. A great example I'll pick here is something like Coast Motors, which we are familiar with. If you look at their financials, they borrow strategically, aligning loans with projected future sales and ensuring that the cash flow from these sales will definitely cover their loan repayments. So our business today is to focus on how you can follow similar strategies in your own businesses. So we'll quickly take a moment to talk about the current economic environment in Nigeria and also globally. Right now, we're seeing inflationary pressures driven by factors like the war in Ukraine, supply chain disruptions, and the aftermath of the COVID-19 pandemic. In response to this, many central banks across the world, including the CBN of Nigeria, have been forced to increase interest rates to control inflation. In Nigeria today, we're witnessing several key economic challenges. Inflation has been rising, causing a hike in the cost of goods and services. And in response to this, CBN has continually increased interest rates to control this inflation, which makes borrowing more expensive for both individuals and businesses. Right now, inflation is hovering above 30%, I think 32.15 for August, if I'm not mistaken. And just 2 days ago, CBN just increased the MPR, monetary policy rate, to 27.25 from the previous 26.75. Now, what does this mean for borrowers? When interest rates rise, the cost of borrowing becomes more expensive, definitely, and this affects everyone. Businesses seeking expansion, individuals looking to finance anything, maybe homes, vehicles, even government seeking funds for infrastructure, everything becomes very expensive. Now, let's take the case of a Lagos construction company, a typical construction company in Lagos. With the increase in the price of building materials right now, they are faced with reduced profit margins. And for them to be able to stay competitive, they need additional financing to complete those projects. However, with the increased interest rates for business loans now, then accessing credits will definitely become more challenging for them. So these are the issues that are on the table. But despite all these conditions, if you are able to borrow strategically, then your business can still navigate through these trying times. Before I dive into the next slide, let me even take, for instance, let's take the one that we're familiar with, Dangote Cement, for example. They've had to calibrate some of their borrowings due to rising interest rates, but that has not stopped them from investing in long-term projects. They did plant expansion in those states. Why? Why did they go ahead to do that, even despite the rising interest rate? Because they understand the concept of going concern. That is borrowing to expand today so that you can benefit from future cash flows. They know their future sales will definitely cover for the current cost of borrowing that they're incurring. So this is applicable even to SMEs. You can actually invest in a strategic business in this high interest environment. If you focus on the long-term gains, you'll be able to use the debt strategically. And by doing this, you position yourself to take advantage of future growth opportunities, even as we say that the economy is tightening. So borrowing is not just about taking on debt. It's also about ensuring that your business remains a going concern. And going concern apparently means you planning for future sustainability. So with smart borrowing, you can take advantage of future cash flows while you're ensuring that your business expands in these tough times. So now we quickly look at what do we understand by interest rates. Let's first of all break it down. How does interest rate work, and what is their impact on businesses? In simple terms, interest rates are the cost of borrowing. That's just the simple definition of interest rate, cost of borrowing. And when interest rates goes up, it means that borrowing becomes more expensive. Think about MTN Nigeria. In the recent time, their borrowing costs have increased over 5%. And it's really affecting the ability to fund network expansion. Same is applicable to companies like Nestle Nigeria. Rising interest rates have squeezed their profit margin as they've had to even allocate more funds to servicing loans, leaving less for growth initiatives. So this shows that rising interest rate can choke a business ability to expand and innovate if it is not managed properly. The key takeaway from this slide is that understanding the cost of borrowing is actually very essential and in making your smart financial decisions. Even with high interest rate, business can still make strategic moves if they know how to borrow smartly. High interest rate definitely slow down expansion, but for strategic companies, it's about timing future cash flows to align with the debt obligation. So you just don't borrow for borrowing's sake, ensure that there's a need for it. And the example here shows that there's a critical need for everyone to understand the mechanism of interest rate, especially in a volatile environment like Nigeria. So just know as interest rates increase, cost of borrowing will become heavier and it will directly impact your profitability, your cash flow, and even ability to repay loans at the right time. We also look at the factors, some of the factors that affect interest rate. There are several factors actually, and understanding these factors can help you to make better borrowing decisions. One of the most significant factor is government monetary policy. For example, when the CBN raised the MPR monetary policy rate to control inflation, banks immediately will follow by increasing their lending rates. And what does this do to us? It will impact borrowing costs. This doesn't just affect large corporations, it trickles down to smaller businesses and to individuals. So let's take the oil sector as an example. When oil prices drop on a global market, Nigeria revenue will decrease, putting pressure on government's budget. The CBN may decide to respond by tightening NPR or monetary policy to stabilize our naira because we are import dependent, which in turn will increase interest rate on loans. So a local distributor of petroleum products that is resident in Lagos who borrows to fund those imports will see their borrowing costs rise due to that global oil price fluctuations. So it's important that how all these they affect interest rate. Another thing is market expectation. An investor is expecting that inflation will keep rising and they demand higher rates to compensate. This is apparently what's happened because many companies now whose borrowing costs are increasing is as a result of inflation. So if you have an expectation for inflation, then people will demand for higher rates rather, so as to compensate for that inflation, and it's happening every day in Nigeria. Supply and demand for credits. When there's a demand for loans, interest rates tend to increase. Look at larger institutions in Nigeria, they typically have access to credit compared to SMEs. SMEs are finding it difficult to access credit. aside the fact that the cost is high, so this is causing a crowding out effect already. And global financial markets have also impacted local interest rates. Companies like Total, Nigeria, they've seen their foreign loans becoming more expensive as global markets conditions worsen. So by understanding these factors, it can help you to anticipate changes in borrowing costs and plan accordingly. Let's quickly look at Nigerian current landscape. In Nigeria, we're dealing with one of the most challenging interest rate environment, like I've mentioned, and because interest rates are the highest, what we're experiencing now in a decade is being the highest. So CBN, by virtue of the being a regulator, plays a significant role in determining the landscape. As we know, like I said, this year alone, the MPR have been raised multiple times just to control inflation. And this has made more expensive for businesses and individuals alike to borrow. So this period is particularly hard on businesses of all sizes where even large companies, they are all feeling the heat because they are reporting lower profits due to higher loan servicing costs. You take the likes of MTN, like I mentioned, Nestle, PZ, all of them recorded significant losses in the past few years, in part of being as a result of cost of their loans. And so that's even the big players. For SMEs, take for instance SME in a technology sector, who had previously taken a loan, let's say, at the rate of 20%. And now you are seeing the rate maybe being increased to 25, 30. So while this environment makes access to credit more difficult, business that needs working capital for expansion are still borrowing anyway, because you can't afford to be stagnant. You need to keep going because stagnation is not an option. So businesses apparently is finding it very difficult. Is a crowding out effect in action, where high interest rate makes it harder for them to access loans. But let me also mention that there are certain special loan schemes, like those ones that were provided by the likes of BOI or CBN Intervention Fund for Agriculture, for instance. They offer lower interest rates. So you can have a farmer anywhere in the country, maybe a farmer in Kano might access funds through from BOI even at single digit rate. Yeah, so this one can help you to reduce your cost of borrowing. This is just an alternative that people may begin to look at in this period. But the big question is, how do you still borrow effectively in this environment? So this is part of why we're here today. Now, to be able to borrow effectively in this environment, um, when borrowing in a high interest rate environment, business and individuals they face several challenges, right? And first, the increased cost of loan. You need to look at it. That's those are some of the challenges. You look at increased cost of loans. For instance, you have an entrepreneur, maybe in the somewhere in the southwest. Let's take Ibadan, for instance, running a chain of restaurants. This person will see their borrowing cost maybe increasing due to rising rates, and this will affect their profitability. Loans will cost more. That's the thing, and repayment will then become tighter when this happens. It's not even for people that play in the betting, the sport betting industry. You can take a bet Nigeria, for they need to upgrade their infrastructure, maybe their digital infrastructure, and that's why the high interest rates. We say that they should not upgrade, but because they need to keep up with the time, they need to keep up with the real thing and meet up with the expectation of their consumers. So they will still need to borrow. How do they do this? And how will they be able to thrive? It means that they need to be able to align this with their long-term plan. because long-term benefits of improved technology will definitely outweigh the short-term cost of borrowing that we're experiencing now. Second, I've also have reduced borrowing capacity this time. That's also part of the impact. And for example, if you take a company who had previously maybe borrowed a 50 million for expansion, now you may now need to borrow maybe 30 million because of higher repayments. So the thing is the capacity to borrow has dropped drastically. And the disposable income of individuals too is shrinking by the day because of cost of goods and services. So there is need to look at so you have all of these things, but you still need to survive. Your business still needs to survive. So by borrowing strategically can help you to now maintain growth in these key areas. Let's also look at the fact that high interest rates can making loan repayment difficult. A trader who took a loan 2 years ago at a lower rate now has to factor in higher operating costs. And so at the time you were taking the loans, you've done your projection to say that, okay, this will be my anticipated revenue and this will be the attending cost. But now, because of high operating costs, you now struggle to meet those repayments, especially with reduced consumer demand. The inflation is also affecting consumers, so their demand is on a low ride. Lastly, I would say high interest rates also slow down economic growth. For instance, I'll use real estate developers as an example here. Real estate developers in Lagos might delay starting new projects because borrowing costs are too high. This will have a ripple effect across sectors, slowing down job creation and reducing consumer spending. Like I said, high rates will slow down economic activity, but they also force businesses to be more efficient. That's the truth. Because in UPDC, for instance, we continue to borrow to invest in prime properties in Lekki, VI, Aja, because they know that the property values will outpace the inflation over time. So the key to borrowing in a high interest rate environment is just to focus on investments that will yield returns that will be greater than the cost of your borrowing. So the need to borrow. Why do we need to borrow despite high interest rates regime? There are compelling reasons, and there are very many. Yes, I mentioned earlier, interest rates are high, things are hard, everything, but you still need to stay alive. You still need to stay competitive. Your business still needs to have that going concern. So with high interest rates, borrowing sometimes is necessary. Take, for example, a Nigeria retailer, let's say somewhere in Balogun markets, who borrows 5 million to buy inventory for holiday shopping season. For instance, Christmas is coming. People are targeting sales that will be done during the festive period. The fact that interest rates are going up is not going to make them to close their shop. So despite the high cost of borrowing, the retailer in that Balogun market knows that demand during this period will be strong and the profit from increased sales will far exceed the cost of the loan. So this kind of person will go into that borrowing and will be able to align that specific borrowing to the sales that is going to make within the festive period. Another thing is the need for business expansion. So you have manufacturing companies, maybe the likes of Goa Cement, for instance. They recently took a significant loan to expand their cement plants in Edo State, like I said. They knew that market demand for these products will continue to grow. People will continue to demand for cement. So the future cash flows of the sales that will be generated from the sales of that cement will definitely cover the cost of their borrowing. So this is another reason why they cannot afford not to borrow despite their interest rates. Companies, technology companies, the likes of IHS Stars are borrowing to invest in telecom infrastructure because they are confident that future demand will more than pay for today's loan costs. Similarly, borrowing for real estate investments remains a sound strategy, in fact, a very sound one. A property developer in Lekki today now may take out a high interest loan to purchase a land, knowing that the property price in the area are rising and is rising by the day. So the returns on that investment could easily outpace the current high borrowing cost, and it will cushion the impact of inflation. So borrowing is also, as we have there, managing cash flow. For instance, a business that supplies goods to supermarkets might need a loan to bridge the gap between delivering the products and receiving payments. You have some people that they supply goods with to collect payments with future receivable, right? So receivable, let's say, is within 60 to 90 days. So what you need to do is that to be able to meet up with the supply demand, this supplier will need to take a loan just to bridge that gap between when you'll be delivering the products and when the payments will start coming in. Giants like Dangote Group today, they've even leveraged on loans to keep operations running smoothly while they're investing in their future growth. So cash flow management is also another major reason why we still need to borrow. Debt consolidation is also another strategy that is employed by many companies. It's just about consolidating your debt to reduce overall payments, even in high rates environment. Also for strategic financial planning, for business like, let's say, let me take for instance, a Seplat Petroleum, but that borrowing is part of their larger strategy for sustainable long-term growth. So it's part of their strategy, and because they're targeting long-term growth, they will continue to borrow because they know that what they anticipate to gain in the long run will cover for the costs that they're incurring on borrowing today. Let's our time is gone. Let's move quickly to importance of making smart borrowing decisions. We've talked about the interest rate. We know the basis. We've talked about the fact that we still need to borrow despite the high interest rate environment. So now let's look at the importance of making a smart decision in those when you take go about doing those borrowing. You know, smart borrowing is all about ensuring that you don't just survive, but you are thriving. So making smart borrowing decisions is critical for financial stability, especially in the high interest rate environment. So let's consider a case of, so today, because all these things, they impact on SMEs majorly. So I always take SMEs as a typical example. So let's say SMEs in the manufacturing sector, for instance, decide to borrow to expand their operations. But before doing so, they carefully evaluate the costs and benefits. So by managing their debts wisely, they will be able to maintain financial stability and avoid becoming over leveraged. So it's not just SMEs, even the top players, the Nestle that I mentioned, they don't just borrow, but you strategize. You ensure that every loan that you're borrowing is aligned with the production capacity and growth forecast of your organization or of your business, so that you are never overextended, so that you don't have you don't borrow for money that you do not have a need for. So, and another good example is improved credit worthiness through smart borrowing. This comes from business in the oil and gas sector, for instance, by repaying loans on time and demonstrating a capacity for financial discipline. This business can negotiate better terms for future borrowing. So in credit today, you look at the C's. maybe the 3 C's, the 5 C's, the 7 C's, depending on how you are doing your analysis. And capacity to repay is one of the key elements of those C's. So it is important. So so the importance of creditworthiness is very key. When you have it, then you have that history, and you can be able to access more loans in the future. And because you are consistent with repayment, you are able to negotiate better terms in subsequent borrowing. Even now that we're seeing high interest and high interest rate environment, so you can continue to align borrowing strategy with your long-term goals. And by doing this, you also avoid debt traps, ensuring that you are not overburdened with any unnecessary loans. So effective borrowing is what actually means managing your interest costs. That's the thing. So we talked about borrowing strategically, smart borrowing. It's about managing your interest costs. A supermarket in Lagos today might be able to negotiate a better terms with a bank to secure a good loan terms. If you have a collateral, for instance, so if you have assets that you can make good use of, you can use this as collateral to access loans from banks, and you can also use it to bring down your price. So these are some of the things that we should look at. A company like let's say in oil and gas sector, or is there now maybe MRS or what have you, can take advantage even of the yield curve by borrowing short term when rates are lower, right? So while investing in the long term assets with higher returns. So the thing. So what I've said is that so you are trying to play around the yield curve. So when you see that the rates are lower, you borrow short term, and when then you can begin to invest in long term assets that will give high, and you're able to seize any opportunities that may arise. So most of the time, that's why as we say that long time, so that you don't get locked in. With short-term borrowing, you can take advantage of any opportunities that may come in. Other debt traps. Okay. I think the next thing we need to evaluate your needs. Take, for instance, a furniture manufacturer. Let's say somewhere in Aba. This person should be able to determine whether borrowing to purchase additional raw materials right now is critical or if it can be deferred. Please, these strategies, they're actually very important for us to pay attention. We've been able to establish the fact that, yes, borrowing at this time is very, very hard. Assets is hard. The interest rate is on the high side. But the point is, because our business still needs to survive, still needs to thrive, we then need to know those strategies or the options that we need to take to ensure that while we're still borrowing to keep our businesses afloat, these are the things we need to do. And that is why I said you need to evaluate your needs. Don't just borrow because everybody is borrowing. Prioritize your needs. Know if that thing you want to borrow to fund, if it is something that can be deferred, then I think you should do that. So don't take on more debt than you need. Regularly, I think it's important that you review your operational needs so as to ensure that you only borrow for critical purposes. The next thing here is, like I mentioned earlier, there's need to consider the long-term impact versus the short-term impact. I'll use a tech startup as an example. A tech startup might need a loan to invest in new software development. While the interest rates are high now, he knows that the long-term benefit of developing, let's say, an innovative technology will significantly outweigh the cost. We know that with the environment we have, we're in an AI-driven environment now, where technology keeps evolving every day. So for a tech startup that has spotted an opportunity in the tech industry and is going at this time to go and borrow, even with the high interest rate, knows that there will always be a demand for a service. And the process, the benefits from that innovative ideas will definitely outweigh the cost of borrowing that is making it. So it's like investment. Same way an MTN Nigeria, we always borrow with their eye on their future growth. So the need to balance your today's loan cost with tomorrow's revenue streams. That's what we're saying. And it's essential also for you when you want to take a borrowing decision to always compare the options. Always look at several banks' offerings before you settle on the one that you will take, the one with the best terms. This is not a time to say that, hey, this is who I've been dealing with. I think you should consider always ask for different options so that you can make the right decision. So you need to review different lenders, find the best terms for their growth, and like we have on the slide, negotiate favorable terms. So put yourself in a situation where you can actually ask for concession to get a lower interest rate. This is still possible. And another thing is you may also be refinancing your existing debts or leverage collateral, such as maybe property or equipment. This can also help you to access a better loan deals. Because let's say, for instance, someone now that wants to expand operations and you have assets. You have assets that you can use as collateral. So why not put in those assets so that they give you, most especially if it's asset that is tradable or that is a very, that the market value is very high. You can use it to negotiate lower interest rates. Right. So consider alternative financing. Okay, so what we're just saying here is that apart from borrowing, apart from going for loans, there are other options that you can use to finance your business. You can do crowdfunding. There's venture capital, which you can also use. A lot of people are using all these options. Farm crowding that I mentioned earlier. They've used crowdfunding in the past, not necessarily going to the bank to borrow. So these are alternatives to the traditional bank loans that is available. And lastly, so in taking decision, now for some people, you may be able to use one or two of these strategies at the same time, or sometimes it may be one at a time, depending on the nature of your business or the situation of your financials at any point in time. But it's always ideal that you seek professional guidance when you want to do this. Some people have their CFOs who can guide them internally, but aside that, you can also speak to your financial partner. It could be banks, it could be a company. That's why what sovereign finance also do here to help you navigate these options and help you make the best decision for your business. So I've said a lot about, I've even used different businesses as a case study, but before I wrap up my path and before my colleague, the second speaker, come on board to tell us how to leverage different opportunities and also how to manage risk that may be involved, I'll take for a typical case study that I want us to just have in mind as we go through this. So let's take, for instance, a Lagos-based food processing business that wants to expand production. just to meet growing demand. As of today, that we have high interest rates. Now, it wants to meet growing demand. It will not stop its operations. Interest rate, NPR was increased, has been on the increase on a consistent basis, and it was just increased again 2 days ago. So you will not absolutely now say that because interest rate is increasing, I want to halt my business. So, but what you were saying that you do is that this you borrow, for instance, maybe you are borrowing to purchase new equipment. That's a strategic decision. The new equipment that you are borrowing will definitely help you maybe to increase your market value or your market share. Let me say market share. You may be moving from a 20% market share to a 50% market share. So what this is doing is that you're able to gain new contracts with large retailers that can boost your revenue by more than 50% or whatever depending on the equivalent to how you're able to sweat the equipment that you've bought and also the new contract that you've gained. So you've been able to manage your cash flow effectively by doing this, and you will pay off the loans. Don't forget, so you are taking the loans today because you are still operating in a small environment. So you are taking the loan, it's looking as if it's a high cost borrowing. But by the time you are able, because you are taking the loan for a specific purpose to buy equipment for expansion, and when you do this, you're able to gain new contracts, you are able to gain new subscribers that boost your sales. And when it boosts your sales, it improves your revenue. This revenue now, by the time you put it side by side to the cost or the financing cost, the revenue outweighs the cost. And these are the kind of example of borrowing we're talking about, that even with high interest rates, borrowing can still be very beneficial when you align it with clear strategies and strong cash flow management. So I'll make a stop here and allow the next speaker to just take us through to the end of the presentation. Thank you.
Wow, that was indeed a very, very impactful session. Thank you very much, Dr. Tunji. I don't think we'll recover from that in a hurry. Please let's welcome Mr. Anthony Kumba as he takes us through the next part of this session.
All right, thank you very much. Thank you for having me. And thank you so much, Dr. Tunji, for taking us on this enlightenment bit of the presentation. So in every tight economic situation, especially where you have an increased interest rate, there are lending opportunities that are available. And so those lending opportunities that are available is what we're looking at, where the lenders will have opportunity to ensure that they maximize the benefits that are available, to ensuring that they take good lending decisions, or rather good decisions in their need to borrow. And part of those decisions, or part of those products that are available for as lending options for the consumer, it's important that he or she abreast himself or herself with the various channels by which they can access facilities and have those their needs met. And for personal loan, one of those avenues or channels is a personal loan avenue. And for personal loan, individuals can access personal loans to meet urgent financial needs that may come up as they go on their daily activities. You may have to pay school fees. I'm sure a lot of us who are parents have had to either make some borrowing decisions to ensure that they're able to pay school fees. So it's a critical aspect of the economy, and it's a critical aspect of the decision that people and borrowers need to take. Also, for businesses, there are business loans that are available. Business loans such as working capital to be able to meet their daily cash flow needs. Is it operational needs? Is it expansion? Is it to buy or restock their goods? Business loans are available to ensure that they are able to meet those targets. Of course, we have auto loans that are available for both individuals and corporate organizations. Today, it is said that a car, for instance, is no longer a luxury. It has become a necessity for people to be able to commute from one place to another. And so people will have to make those lending decisions or borrowing decisions to say, oh, I need to have a means to move myself or my goods or my services from one place to the other. And in today's Nigerian economy, raw materials will need to move from one destination to another. And to facilitate that, people will need to have auto loan options. We also have mortgages that are available through facilities that helps them to pay their installment on a long term. People can even do options of rent now to earn as part of the options that is available. And so individuals will be able to take advantage of mortgages to be able to meet their housing needs. Then there are options of overdraft facilities that are available for individuals and SMEs where they can take short-term facility as working capital needs to be able to meet operational exigencies that may come up as time goes on, or to pay salaries. It's important that some organizations will have to take overdraft to meet up that needs. And so there are options that are available. Then for microfinance loans, there are options that are available to the unbanked member of the community or banked member of the populace who may not have the structure or the capacity to approach the commercial banks or the major commercial banks. And so we have the microfinance options for them to be able to assess those needs of theirs, and then they'll be able to access micro loans to either as a startup or to be able to boost their businesses. You have Basira on the road who has a small mini kiosk, Mr. Johnson on the other roadside who needs to expand his businesses. In today's modern economy, the SMEs are the driving force for the economy. And of course, it's important that the microfinance will play, or the microfinance banks will play a role. And as we go along, I will explain how they can take advantage of that. And then we'll have credit cards where limits are set for individuals who can draw down based on those limits to be able to make operational expenses and meet their operational expenses and meet their operational needs. And then we have Islamic bank product for those individuals who, because of their faith, they will want to maintain a non-interest arrangement or product or partnership, as it were. And so it's important that for those segments of people, they too are adequately serviced. And so it's important that that aspect of that arrangement is also made available for them, or going into a non-profit sharing arrangement. And so in analyzing this, we will need to look at those specific sectors, those specific lending options that are available for the specific sectors. And one of those sectors that we're looking at is the agricultural sector. Today, food has become a very essential need of man. And to be able to meet that essential needs, goods must move from the point of manufacturing to the point of sale, and then to the point of where it reach the household of individuals. And so there'll be lending opportunities and needs to be able to meet that target arrangement. And so there are lending opportunities that are available for agricultural expansion, or B, improvement in tools and equipment. There are lending opportunities that are available with that sector as well. People, farmers will want to buy tractors or hire tractors, as it were. And of course, a farmer who owns birds will need to have his cage or need to buy additional birds to be able to meet up with the demanding needs of the public. And then we'll have need for renewable energy. In today's Nigerian economy, the need for alternative energy source have become very vital. And of course, it is important that they look at those factors. And a good example is using inverters and solar systems to be able to ask, or as an alternative source of energy. Today, we all know the cost of diesel in the country, and running businesses with energy is very critical, especially where you have people who are involved in frozen food business, for example. They will need to continue to keep their cold room running. And to do that, you need energy. And so options that are available is to go into the right of solar systems. And that is very cheap in the long run. At least it's important that we look at that aspect. And then for educational loans that are available. We're also critical in looking at this area in terms of parents who will need educational loans to be able to meet those needs that will come up as the awards head for the schools. And of course, even for the schools, it's important that they too will need partnership arrangements or product that will meet their needs. Sometimes schools may need to have options that are available for their expansion to meet up with increased numbers of pupils that are coming in. Even for the private sector, we are beginning to see new schools coming up, and those schools will begin to need lending options that are available to them and making those wise decisions to have those lending options. And then for housing today is an important aspect of Nigerian, and it is said that the number of available housing to the number of the populace available, it's very minute and not sufficient enough. And so agencies and government are doing their parts, but of course, as individual, you must take advantage of those housing opportunities that are available for mortgage or having those opportunities for rent to own options that you have. And then for SMEs, people need to boost their businesses. Businesses are facing a lot of challenges today in transportation, moving goods from one place to another. In importation, it's very critical that we begin to have access to those lending opportunities. And then other sectors we'll be looking at in specific options are options of the technology. We have the lending, the retail lending, then we have manufacturing, and of course, healthcare. In technology, lending institutions or organizations who go into lending are beginning to avail themselves with those technological means or expertise to be able to reach a wide range of the public. We know today that with technology, you can reach a wide number of people. And so there are smarter products that are coming up using the smart app, loan apps that are coming up, offering people opportunity. You can sit at your home and be able to access lending products at the tip of your fingers. And of course, there are opportunities where we have nano loans. Those nano loans offer those smooth credit, smart decisions that you can have access to meet your daily needs as you move along. And then for lending opportunities, we have people who may take advantage of those various products in the consumer finance industry. For instance, personal loan for salary earners, SME loans for SME people who may want to expand their businesses and may want to grow, as it were, to be able to meet the operational needs of the expansion. And then for manufacturing industries, we have people who would want to, SME borrowers who want to expand their businesses, and there's need for them to acquire equipment. There's need for them to ensure that they have support to raise funds for raw material, for equipment, and to cover operational costs. So to run a business today in Nigeria, it's important that you have that backbone, that financial backbone, that leverage for you to access loans. And then in the healthcare sector, we're also looking at the unsecured loans that are available in those areas to meet the healthcare procedural emergencies that will come up. Today, health is an important aspect of human endeavor, human lives. So being healthy and keeping yourself alive is important. But where there are health challenges, there are opportunities that should be available to access. Then we will now look at those risk management in borrowing, those strategies that are effective in ensuring sound risk management in making the borrowing decisions. One of those sound risk management decisions that we need to take in borrowing is to ensure that as interest rates fluctuates, people's ability to pay loans will continue to increase, and we'll begin to see rising costs in borrowing. And for that, you will see individuals whose disposable income, as it were, may not be able to meet up. And so how are organizations managing these opportunities? And even as an individual, how would you be able to ensure that while you meet up with your daily expenses, you still have disposable income to ensure that you meet up your loan obligations? And for credit risks, we'll look at the risk of default to financial institutions. People today, especially if you take, for example, during the COVID era, we had instances where people would have to work smartly. And to do that, a lot of people had to lose jobs. People had to lose jobs, and by losing jobs, what that means is that also you will now have to lose opportunities that are available to you. And so be able to service debt became an issue. And rising loan portfolio became an issue in the industry. And of course, as an individual, your credibility and your credit score will be determined wherever the individual needs to take a borrowing decision. And so it's important that you ensure that your credit score is kept at at a level that determines that you have that capacity to be able to pay. And institutions, of course, will be able to look at that area as well. Then for currency risk, it's important that the exchange rate, as it fluctuates, and as people begin to look at the differences and the slight shift that have been noticed in the industry, what that means is that people will now begin to ensure that you don't take loans. For instance, you take a foreign exchange currency loan, and what that means that you will now need to use more of the naira that's available to you to be able to pay off those currencies. So it's important that you take smart decision in ensuring that you hedge those risks. Then for liquidity risk, it's important that individuals must consider the fact that whatever collateral you are using as your edge to be able to borrow, that collateral is such that you'll be able to dispose of to pay off the loans. And individuals and lending organizations are beginning to look keenly into those areas to ensure that as I take the facility, do I have what it takes in the event that I'm unable to pay? Can I dispose of these assets? If an institution finance a car for you, for instance, if after making some down payments and then along the line you're unable to pay, can that facility or rather that asset be disposed of to pay off the loan? That is also important to the individual to consider, as well as for lending institutions, as well as the lending institutions to look at as well. All right, so let's go to the next slide, please. All right, so there are other risks or losses that are very important for individuals and lending organizations to look at. In risk management, in taking those decisions, there are operational risks that must be looked into. And those operational risks are as a result of failures or rather internal failures or operational deficiencies or technology failures that may lead organizations to suffer losses in those areas. And so it's important that you have a robust system that takes care, or a robust strategy that takes care of those operational losses that may eventually occur. But even in that atmosphere, we will also look at those opportunity costs that we need to look at. If I take a decision to borrow, or as an organization, as I take decision to lend, what are those opportunities I need to look at? If I borrow out a loan to an individual and he uses a car as a collateral, in the event that he's unable to pay, what are the alternatives I need to look at to pay off those loans? And it's important that you consider those aspects. And in mitigating other associated risks that are associated with borrowing, it's important that the key other variables that we need to look at, very key, is the interest rates. People must understand, and then organizations and individuals must understand that if you have a long-term project, it's important that that long-term project, you go for interest rates that are variable or adjustable interest rates. Where there are changes in the interest rate, you can ask for a restructure or seek for a refinancing, as it were. But for short-term project or short-term needs, it's important that you go for fixed rates where you just immediately be able to pay back. Give you 30 days facility, and then you lock in a rate within that period. Therefore, credit risk is important in mitigating a credit risk. The borrower must maintain a sound risk, or rather a sound credit history. My colleagues have mentioned capacity. If an individual does not have a capacity, or his borrowing history shows that he or she has defections or has bad credit history, organizations will not lend to such individuals, or corporations will not lend to such individuals. So it's important that you maintain a good credit history, you pay up on time, and where you're unable to pay up, there are restructured options available. And so that is a critical risk that we must be looking into. Then for liquidity risk, it's important that assets that are used as collateral can easily be liquidated to ensure that those loans are paid off. If I take a facility and I'm using an asset to back up those facility, is that asset easily disposable? If I use my property, for example, can I easily be able to dispose this property to be able to sell off, or rather clean up the loan? Those are the technological pitfalls, those technological man-machine equipment that we looked at, or operational deficiencies are important for us to look at. You must ensure that you maintain a major fraud case. How do they survive, or how do they recover from such issues? There must be insurance cover to cover for such issues. And we've had instances where there are fire incidences, where a business goes down. What are the insurance opportunities that are available in such areas to be able to recover for such hazardous occurrences that may happen, or such risks that may occur? Therefore, for other risks that are available, we must consider the opportunity cost involved. Why do I have to lend, or why do I have to take a loan facility? Is it profitable in the long run? Those opportunity costs must be looked at. Vis-a-vis trying to understand that in lending, individuals must take those decisions to leverage. And now it's important for us to look at the aspect of the leveraging financial expertise to ensure that you have a sound knowledge of what it is that you need to do. And sovereign finance as an institution, has come in to play a bigger role in ensuring that individuals will take sound decisions in lending. And so sovereign finance have made opportunities available in giving individuals personal loans to meet personal needs. Your salary is easy to take facility. Or auto loans, people will take opportunity to take auto loans. And then for businesses, of course, SME financing, meeting working capital is essential. And then for contractors and business owners who have businesses to meet up, and then LPOs to meet up, or invoice discounting, sovereign finance has those tailor-made products that will meet your needs. So we are available for you to consult with us, and we'll give you those. Then for the unbanked member of the society, as an institution, we have Liquid Crest Microfinance Bank that will cater for target individuals and small businesses who lack those access to conventional banking facilities. And so those individuals who fall across the public sector, the paramilitary sector, even those who are market women and market men out there can take advantage of those products that Liquid Crest Microfinance offers. And so there are salary earners who can take advantage of pay loan for microfinance scheme. And of course, it's important that as a microfinance bank, we also cater for the banked member of society by creating a micro loan scheme where we take care of individuals who can form themselves into groups or into clusters, and they can be able to come together as one unit to be able to access the facility. And of course, for individuals or corporate bodies who want to acquire assets, we have the buy now, pay later scheme that they can have access to. And so we have expertise, we have what it takes to present those products to you and be able to service the bank member of the public. And so these are the functions and rather the expertise that we have in the industry to be able to service individuals who want to take lending decisions, a wise lending decision in the industry. So I want to thank you for joining us on this call, and I'll leave my colleagues to take you through all the avenues you can reach us to be able to discuss with us and see how we can meet those critical needs of yours. Thank you so much.
Thank you very, very much, sir. Thank you so much for that. Wow. So if I do say so myself, this has been very, very comprehensive thus far. I'm very sure that we've taken a lot of lessons, spanning in and around what interest rates are, their impact on our borrowing decisions, why we need to borrow, the importance of it, and of course, strategies for smart borrowing and the risks associated. And of course, as Mr. Anthony Kumba has mentioned, we at Sovereign Finance Company Limited and Liquid Crest Microfinance Bank, we have different products across, our product lines that are best suited for different needs. So please, by all means, feel free to reach out to us. We know that, of course, it doesn't stop here. This is only the beginning, right? So please feel free to reach out to us at any point in time through our phone numbers as displayed on your screen, our email addresses, our social media channels, as well as our website, for further financial advisory or clarification on any of the things that has been mentioned here. So real quick, before we round up the session, we'll be taking the question and answer segment, right? Please, again, like we had mentioned at the beginning of the webinar, if you have any questions, please drop them in the chat room whilst we start to address the questions that are already there. So our first question here, we have, you mentioned the scenario where a business needs to acquire an asset and pay over a period of time, like 90 days or more. What options would you recommend for industries like agriculture, where the business cannot pay in installments, but rather pay all at once at the point of harvest? Dr. Tunji, can you please help to address this? Very good question, actually.
Okay, thank you, Precious. Done a good job so far. Okay, so very simple. In the course of the presentation, don't forget we said it's important to map your borrowing need to your need. And in any credit management or credit analysis, you don't just give loans in isolation. You do industry analysis, you do business analysis to understand the peculiarity of that particular industry. So for industry like agri, where revenue generation is always cyclical, that is from your question, where the pattern is tied to harvest period. So traditional loan structure may not work. So in such cases, you have borrowing options with flexible repayment times that will align with the cash flow from the harvest. And there are different options which are available, which I know, and that also exists in sovereign finance today in the course of credit analysis. You can choose to go for a loan that allows you to do bullet repayment. Bullet loan is the one where you defer the principal payment until the end of the loan, and the cost of the loan you can be repaying the interest, so that you pay the principal at the maturity, that is at the harvest time. So you can do that. If you are not doing that, there are institutions, there are also some loans that are targeted to agree. You have commodity-backed loan, for instance, where you secure the loan by using your future harvest, even as collateral. Because so instead of making cash payment, you know that the harvest time can be used as a collateral, and so it's tied to that. Agree, because we have products that are also seasonal, right? You can also decide to take a seasonal working capital loan. That is when you apply for working capital, your business is analyzed in such a way that it will meet those seasonal cash flow from your business. So at harvest period, that is the cycle of your agree needs to be factored in. Or another thing is it can also be where you are doing an option where revenue-based financing, for instance, where the repayment is tied to the revenue rather than the usual fees installments that you get. So you just in this case, you've had a situation where some people you can do JV, you can even do JV with your lender, So what do I mean by JV? So it means that the lender will be taking, you are not repaying. All you are doing is to get from the revenue at the end of the day. That is, the lender is part of the business. So the repayment is tied to the farm's revenue rather than those installments. So the lender now will receive a percentage of your sales at harvest time. So that will make your repayment to also be very flexible. And aside from this, there are so many microfinance banks today, including Liquid Crest, that even have a specific products for agri, so that you have repayment cycle structured around your farming cycles. So the loans can be made flexible in this way. And that's why in the course of our presentation, I said you should not just going for borrowing because everybody's going for it. Ensure that you do your due diligence to know the loan options that you go for, the one that will align to your business cycle. So that's what I think you should go for, not the traditional loan repayment cycle.
Okay, thank you very much, Doc. I hope this answers your question, Mr. David Ayodeji. Again, please remember you can always reach out to us. We do have solutions available that can cater to your needs. Another question that we have here is what's the best financing available for real estate? Doc.
So yes, I'm here. So I would say that the best financing option for real estate will depend on the specific need of the project. For long-term investments, let's say like residential or commercial property acquisition, mortgage financing may be appropriate, or you do REITs, that's a real estate investment trust. That could be an ideal one. But if it is for short-term needs, you may want to go get bridge loans that can offer some kind of flexibility. Because any developer that is looking to scale without increasing debt might also consider equity financing. That is, or DP, like I mentioned, joint venture. So there are also more innovative options that you can consider, like the crowdfunding I mentioned earlier. They also provide opportunities for small investors. So any of these options, they have their pros and cons, but it's just for you to do, just choose the one that you do your assessment properly, the one that will align with your project, timeline, the risk, or the cash flow, as the case may be. Yeah.
Thank you very much, Doc. And please, of course, remember that you don't have to do it alone, right? You don't have to do all of the assessment. We know it can be a little bit tedious, or a lot tedious actually, to do all of the assessments by yourself. Remember that Sovereign Finance Company Limited and Liquid Crest Microfinance Bank is here for you. And one last question before we call it a day. We have, please, what part of the scheme takes care of LPO financing and how does this work? Doc, can you please help to share more light on LPO financing, sir? Hello, Doc. Okay, I'm not sure if he can hear me. Mr. Anthony.
Okay, I think I can quickly take that.
Okay, yes.
Yes, I can quickly take that. Yes, I can quickly take that. We have business loans that takes care of LPO financing, where an individual has a PO, an invoice, and he or she needs or lacks the capacity or has shortage in funds to be able to carry out those POs or execute those POs effectively. We come in as a financial partner to ensure that we meet up. But of course, there are risk acceptable criteria that are set for individuals or businesses who have POs to finance. It's important that we confirm those invoices and ensure that you as an individual or a business have the capacity to execute those POs. So it's also important that not just looking for institutions that will finance it, do you have the capacity as a business to carry out those POs? And so we will continue to assess businesses based on their capacity, based on their history. Have they carried out project before? We will look at those indices and those criteria to be able to assess. But of course, we have products that cater for LPO financing. We can ask if you have such POs, you can approach us. We'll have the conversation and be able to see how we can finance your need for you. But of course, it's important, like I've said earlier, that you understand that you must have capacity to be able to be able to carry out those POs effectively. And have you done that in the past? So those indices will be looked at. And so the answer is yes, we can finance, and we have product to cater for those kind of need.
Okay, thank you very much. I hope this answers your question, Mr. Kazim. Once more, we say thank you very, very much for yielding to our call and for your time. We appreciate your time and your participation. Please, yet again, know that it doesn't end here. Please feel free to reach out to us across any of our social media channels, our website, or any of the numbers as was displayed on your screen. And of course, this webinar presentation will be available on our website for your download. Check the blog segment of our website, and then you'll be able to get access to this. Thank you once more for your time. Do have a good rest of your day. Thank you, everybody. Bye.
All right, thank you.